Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from 22 years in the game, so you can skip the mistakes and go straight to property investment success. How you going, Jez?
Good, thanks. How you doing?
Oh man, not bad. Been a busy week.
Yeah, always a busy week.
Yeah. What's been happening?
Business as usual.
Yeah. Okay. How about I bring up, what have I got here on the Chrome? Channel 9. You're on Channel 9. Talk to me about this. How did it happen?
Okay. So Channel 9 asked for some data and, then they gave me an interview.
Yeah,
They just asked a few. I'm there for like 5 seconds.
5 seconds. Okay. Well, let's have a look. So what was it about? High demand and rising rent?
The toughest markets in Sydney and Melbourne to get into for both buyers and renters.
Yeah.
Well, that was the brief.
Well, let's have a
Rising
look.
rents and property prices. That's the dire picture of Sydney's
We'll fast
housing
forward a little
market.
bit. Let's
The
go.
toughest property markets in Sydney.
Buyers have got high
There
interest
he is.
rates, high prices, and renters have got just chronically low vacancy rates.
DSR data crunched the numbers, scoring Sydney's
There you go. See, 2
affordability.
seconds.
No, there's a little bit more at the back end. Let's have a look. I'll
Now
fast
there's
forward a little bit.
push
Where
to
are
look
you?
at new ways to fund
Here we
more
go.
housing.
100% over a year.
So rent, 39%. So
Yeah,
I actually noticed.
some of them were outstanding. Like you picture yourself being a tenant in this area, like St Peter's in particular. But I think the average for all of these top 20 was like 20% over the last 12 months.
In rental growth.
Yeah.
And how about over the last 12 months for nationwide? I actually know the exact percentage because I checked it.
Go
Do you
on.
know what it is or not? Have a guess.
I don't think it's as bad as 20%, but it'd be up there.
12.94% over the last year. But I think that accounts for units and houses. So pretty much.
13%. So it's. I mean, we've got cracking inflation, but it's still more than double that.
Yeah,
or
let's-
about double that. Yeah.
let's
what
finish
we've
it
got
off.
in these suburbs is average rental growth over the last 12 months of 20%. And that's because vacancy rates are just abominably low.
Schools, transport, or
Love
even
it.
living close.
Yeah, I just had to bring that up.
Okay, so it was an eventful week. There was some dramas.
So how did they approach you?
It was a marketing company, a PR company actually. They were working for a client who wanted some data, and then so it's what is it? Crowdproperty.com.au. So they fund small time developers. So you want to build say 3 townhouses on your block of land. How do you get finance? Sometimes it's a bit of a struggle getting it from the banks.
Yep.
And so what they do is they get investors to put in some cash. So it's like I think it's like a fixed term deposit. You put some money in, you get, I think it's 8.5% interest, and then the developer, which is a small time investor, they borrow that money, do the project, pay everyone back, and it's just a way of getting funding.
Okay, perfect. Where was it done? Was it in the city?
Where was that?
Doesn't matter.
Lower North Shore somewhere. Why can't I remember?
So you cop the traffic.
It's Alzheimer's.
You cop the traffic, yes?
It's only a week ago.
Yeah. And also I noticed on your, we won't bring it up, but your LinkedIn article.
So, this guy was talking about Sydney being king for capital growth.
Yep.
And pointed out this property had grown by I think it was 5.5 million. It was sold recently for 6.7 million, but it last sold something like 25 years earlier, 1998, for 1.25 million.
Okay.
And so he'd calculated the capital growth of something like 6.9%. And I just did some comparisons versus, it was in Balmain East. And it did outperform Balmain East's median value over the same period of time. But the local government area of the inner west outperformed Balmain East.
Okay.
So the property underperformed the LGA, it underperformed Sydney, it underperformed New South Wales, and it underperformed the national growth rate. So out of the 5 benchmarks, it beat one.
So it's interesting. It's just all opinion, isn't it? Or marketing.
Yeah, I mean,
really?
It sounded like, wow, this is great. But it was nothing special.
Yeah, okay. No problems. And it's it'd be interesting to know when they do this sort of back testing with these numbers, is it actually are there renovations added?
That's right. Veronica Morgan picked that out.
Because that's what a lot of them do, don't they? They go, okay, let's back test this property, or has it had renovations? Has there been value add?
Yeah. I mean, if there was renovations like 20 years ago, probably low impact. But if it was just the other week that the renovations were finished and it was put on the market, then, yeah, that's a significant capital injection. It's not capital growth.
Yeah, okay. Yeah. Good stuff. Well, yeah, I like your LinkedIn articles that you normally do. You know what I do every week or every 2 weeks maybe?
I don't have anything. Something triggers a nerve. That's when I respond.
All right. Well, look, so today we're going to be discussing what type of property you should buy as an investor. So again, this is our opinion. Like all of this is general in nature. No, I guess, financial advice. It's just from our experience and how we can potentially, I guess, add value. But what should you buy? What do we get cracking with it?
There's a lot of options, isn't there? Do you want me to kick off with the first one? Well, you do it. You do residential.
Yeah. So obviously, like, you know, where everyone really lives, houses, apartments are mainly.
Yeah, it's living accommodation.
Living accommodation.
It's the most common type of property in the country.
So it's, I guess the advantages is it's very stable, isn't it? Like with the population and not many properties, even a lot of the high rises, I think like a lot of those properties are getting absorbed, even though we'd stay clear of those type of that asset class. I think residential properties is what a lot of people get started in.
Yeah, and there's some good reasons for that. Like it's easy to understand because most people are human beings.
Yep.
So most people know where they want to live. And as a property investor, you just need to think like someone who wants a roof over their head at night. So that's easy.
Well, that's it. Yeah, people need a place to live, but you can just sort of see just with the rent increases, vacancy rates are low, stock of market's really low in a lot of these areas. And I notice working with a lot of clients, just starting out, they just like that security of property. So you're just getting more and more younger people sort of getting in to the market, and it's driving up a lot of these prices. And I guess, look, there's a lot of buyers agents out there now too, aren't there? So you got more and more competition, not enough properties, and it just goes.
Yeah. And one of the things I really like about residential property is, being a numbers guy, massive amount of data. Like you compare residential to others, which we'll come to in a minute.
Yep.
There's just so much more data, so much more volume. There's a lot more security in understanding what's going on from a data-driven investment perspective.
Yeah, it's easier to research, isn't it, like what you said?
Yeah.
And then the other bit is commercial. So like could be offices, retail spaces, industrial properties for business use. So that can obviously vary. I haven't had much experience in. I have had clients in the past where they have had it in their portfolio. Obviously the rents are quite high, like the yields. You've got longer leases potentially, but it's harder to do research, isn't it? Because it's not like we can do stock on market or. That's
right, and there's a new kind of thinking that you've got to introduce into your research. You've got to think like the business that wants to occupy that space. So you need to know the industry that you're appealing to as a landlord of that property. So it's a little bit of a further stretch, but it's not impossible. And I know that a lot of residential investors, after they've had a lot of success in residential, they're more cashed up and they're looking to retire on their portfolio, so they want to increase the yield of their portfolio. And that's usually the trigger to switch to commercial from residential. But you've got to start in residential.
Yeah, and I think you just have to obviously do, I guess, your research. I think for us, though, it's difficult to do that around that commercial space. Sometimes a lot of it's maybe brand new commercial properties being built, but I think if you are, you can always just go online and try and see, like, is there a lot of stock available in the certain area that you're going into potentially?
Yeah. Vacancy rates are a huge issue for commercial because you could have no tenant for a long time, whereas in real estate, especially now in residential real estate, you don't have to wait long anywhere in the country at the moment to get another tenant. You need to be very cashed up if it's commercial.
And I think it's obviously stricter lending can also play a big part in that commercial part. I think you can touch on this one a little bit more. Real estate investment trusts.
Right, yeah. So not being an expert in it, I'll just sort of define what it is. So this is where you have an organisation, a trust, that invests in real estate, and then you have unit holders. Now, when I use the term unit here, I'm not talking about a unit or like an apartment. It's like if it was a company, it'd be a share in that company. So each little portion of that trust is called a unit. So the unit holders benefit from payouts, maybe the units increase in value, but it's like a fund manager. Fund manager just buys a large amount of real estate, so it's an easy way to get into real estate without having to fork out $100,000 plus to actually buy an individual property. You can invest in this trust.
Yeah. Are there a lot of companies that do that or not really?
Yeah, well, the majority of them, I think, are listed on the ASX. So it's not huge, but you can find them. They quite often do commercial type stuff. They do large projects, maybe large development projects. But it's the benefit is you get in for a small amount of money.
Yeah, I haven't seen too many clients invest them. Like, clients would come to me, I'd sort of, do analysis of all their finances and notice it's either like property or maybe some shares. I think they're sort of the main two that I think I notice the most. Next one, how about vacant land? Vacant land. So I guess this is where just a block of land, really. So there's a lot of development depending on where you go. So you can always look at, I guess, the local government areas, websites, Google Maps, satellite imagery.
Yeah, well, you had a good experience with purchasing some vacant land not so long ago, didn't you?
Yeah, well, I think the thing is it's just you got to be aware of the supply. So land and house packages we just see as being higher risk. Not to say that it doesn't work, but it is.
It is higher risk.
It's higher risk, but you can negate that. So a way that you can maybe negate that is you buy the block yourself, wait till it registers. So there might be a bit of a lead time. You might need to put, let's say, 10% deposit down. It gets registered. You might have to wait 18 to 24 months. It really depends on the council. And then you have the hassle of, I guess, building. And I guess building today is difficult because
construction costs.
Yeah, but even short supply of workers, tradies. So my advice around here would be, again, just general in my opinion, is if I'm looking into these type of areas, I'd be I would mainly want to go for something maybe established with a bigger block to reduce that risk. But you do your numbers. Like if the block of land costs you, let's say, $500,000 and you're building a house, let's say for $500,000, there's $1 million there. But then let's say you're getting a bigger block, an established house for, let's say, $700,000. You're further in, maybe closer to the beach or whatever it might be. You're getting more of that land content, which I think is less riskier. But not to say you build a brand new house, people do get emotionally attached to it. Like brand new, you can just sort of go in there. You can design it the way that you like. So there are, I guess, pros and cons to both. But I think just be aware of the supply. I know there was an area, I think it was like Donnybrook. I haven't been there for a while, north of Melbourne, and I went for a drive there maybe 4 years now, just farmland, like just constant. But then I've been in other areas where, they might be only releasing 200 blocks every year, but then you've got thousands of people registered. So it's just driving up those prices. So what people do is they, put money down for the block, but then when it registers in 18 months, it's worth a lot more. So again, you just got to do your analysis.
Yeah, if demand exceeds supply, then even greenfield estates will have money.
Yeah.
It's just that for novice investors, there's a little bit of tricky research that you've got to do there. But one of the big advantages of buying land, so there's this thing called land asset ratio. I'll just do a quick comparison, just how important this metric is. So let's say you got two properties for $600,000. One's a brand new property and you pay $200,000 for the block of land, because to a developer, the purchase of the land to build on, that's a cost.
Yes.
So if they have to factor that into their project, they want to minimise that. Whereas an investor, it's the land that appreciates, the building depreciates. So we want to maximise the land. So let's say you have $200,000 block of land with a $400,000 property on it, a new house and land package. That's a land to asset ratio of 33%. 200,000 into 600,000, 33%. Now, if by comparison you buy an established property, the block of land might be worth 400,000, and then the dwelling on that, because it's older, 200,000. So you've got a land asset ratio in this case of 67%, double what the new property had. Fast forward, say, 10 years. Let's say both blocks of land have doubled in value. So the $200,000 block of land is now worth $400,000, but at the same period of time, the $400,000 dwelling on it has halved in value because of depreciation. It's aged. So it's gone from $400,000 down to $200,000. So you've now got a $400,000 block of land, a $200,000 property. It's still $600,000 after, a decade? Contrast that with the established property, $400,000 has doubled in value to now $800,000. The $200,000 property is now only worth $100,000. So you've got a $900,000 property versus a $600,000 property. They've both had the same growth rate. They were both the same price. One had double the land asset ratio of the other, and so you've got a $300,000 difference. That's how important land asset ratio is. Block of land, 100% land asset ratio. But there are some disadvantages with it. Actually, what about lending? Is it easy?
Well, it's not generating an income right away, so that's a big part in it. I think if it's going to be built for maybe investment purposes, I think they can factor the income, but you have to be careful. You put money down on a block, then you might not be doing anything for a while.
Yeah.
And I have had clients where they've bought a block and I'm like, okay, well, what are you going to be doing with it? Oh, we're just going to sit on it. So it's not generating an income, which is a big one. So it's like, okay, well, do your research. Is that land going to go up in value? That's the first thing I say if I'm reviewing a portfolio. Is there going to be that increase in capital growth? And then do you put a dwelling on there? Is it worth putting a dwelling on there to start generating that income? Yes, you get depreciation benefits, but again, your land to asset ratio might be a little bit lower, but you just have to do your numbers. Like I said, so sometimes these areas, like these brand new properties are worth more. Like maybe the area might have escarpment views, maybe the infrastructure's a lot better internet. Like these things people don't really talk about, but it can have a bit of an impact. So I think it just really depends.
Yeah, if you aren't generating any income because it is just a block of land, then you can't claim deductions like council rates. I mean, you're not going to need insurance because it's just a block of land.
That's right.
But yeah, you can't deduct the interest that you're paying if you borrowed to purchase that block of land.
I don't know how it goes here. You have to talk to an accountant about it. It's been a while, but I don't know if it goes on the cost base of the asset, like depending if it's going to be an investment or an owner-occupier. That's, I think, the first distinguishment. Is it going to be an investment or an owner-occupier? But I don't know if you can do it as a deduction or if it just goes on as on the cost. I think it's a cost base, I'm pretty sure, but talk to your tax accountant.
Yeah, and another horror story along the vacant land. My parents, they bought a block of land, where was it, Port Stephens, something like 45 years ago, and they were hoping for a change in zoning. Still the same zoning today. So they were land banking. That bank has not given them any sort of returns.
And anyway. I think you have to be aware of going really far either, like 3, 4, 5 hours, like where there's nothing there too. So you just want to make sure that there's going to be that driving growth.
Yeah, that was a good one for vacant land.
I'll let you. Do you want to tackle the next one? Maybe like dual lock properties.
Yeah, so excuse me, dual occupancy property. That's like where you've got two tenants, so you're getting double the rental income. It might be a duplex.
Yep.
So you could have the same dwelling, but just sort of split in two, so that there's two separate tenants residing there. So I guess the advantage is you've got two income streams. One tenant could go out. You've still got at least one there generating some income until you can get another one in. And most investors pursue this for higher yields.
Yeah, I think the other thing you need to factor is, let's say you buy an older property. Do you, let's say 700 square meters, again, depending on the area, do you knock it down and put a duplex on there? I know people like that idea. I think it's good to have a property where you can do some type of development for the future. But it's like, how's that going to impact? I guess lending's a challenge, but you got to look at recent sales, I would say, in the area, and then also rents. What type of rent can you get for a dual lock type of property? Because it's like, all right, well, if I've got that established house, let's say it's 50 years old, it's just ticking along. You might put a granny flat out the back. Is that a better option? Because it might be, let's say, 130 to 150,000. So that might be better of a yield play. Otherwise, you just knock over the house and then you get like a dual lock or a brand new home. But just research.
Yeah, I guess you've got to also think of resale. Who are you going to sell it to should you decide to sell it prior to retirement, say pay down the mortgage? Maybe this area hasn't been performing well and it's highlighted as the one that you need to offload. So who are you actually going to sell a peculiar property to? You don't want to limit yourself. You want to appeal to the most amount of potential buyers so that there's more demand for it.
And you can see, like, if there are, like, let's say townhouses going up, or let's say more duplexes, you can keep an eye, I guess, on that market by looking at the recent sales.
Yeah, actually, that's one risk to consider. Like, if you've got a house on a single title, how in a built-up area could it become a victim of oversupply? It's not really possible, but you can have a lot of duplexes pop up, a lot of townhouses, units. So if you do convert your property to a duplex, then you run the risk of oversupply if a whole bunch of other landlords decide to do the same.
Yeah, cool. All right. Well, how about holiday rentals? So I think, again, I've had a lot of experience with clients in this where they've come in and I notice that the rental income is high and I'll be like, okay, Airbnb typically is what it is. So it's an Airbnb property. Again, you'd have to talk to the lenders. I think a lot of them might not use that income right away for serviceability, but then later on, I think they normally like to see about 2 years worth of how much income is it actually generating. I guess the big advantage is you can still maybe go to that property and live in it for a little bit of a holiday getaway. And then also that higher rental income in those sort of peak seasons, you can really generate some good money.
Coin,
But I guess you might not have that consistency there. And I actually think some areas or councils are limiting how long you can Airbnb a property for, I'm pretty sure.
Yeah, they're cracking down because vacancy rates are so tight at the moment. But the other thing you've got to consider is, well, you are going to have a larger vacancy rate. And then there's more maintenance, like you've got to get in there and clean after the last tenant. So a few more things to consider. Yeah,
awesome. All right. Well, how about renovation projects? This is more along the lines, I think, strategy. So I would think of that as something simple. You buy an older house, spend, $10,000-15,000, carpet, maybe paint, fix it up a little bit.
10 or 15,000 sounds.
Well, that was actually, let's
great.
say it was maybe 3, 4, 5 years ago. Maybe it's a little bit more these days, but I guess it depends on how much work.
Cosmetic reno.
Cosmetic.
Tidy it up,
Or you can do those sort of big renovations where you add the second story or an extension where they can take up a lot of time. I think people watch the block and they think, oh, this is great. Let me.
Yeah, well, the reno flip, you're not gonna get out on. If you purchase a property, renovate it, and then sell it, you're gonna have to do a major reno. You can't do something that's quite simple like $10,000 or $15,000 and then expect to increase the value of the property by 30% just by doing a $10,000 or $15,000 reno.
Yeah, you just got to be aware of the headache. Do you have to move out potentially too? So can you live in there? If you're renovating, these are things that you need to think about because that's another cost. You might need to move back in with family support, or maybe it's you got to go out and rent for a year. Again, you have to do your numbers.
Reno flips.
Then
yes.
You've
got developments.
I think the time is most probably the big one with the renovations.
Yeah, because it's usually DIY.
I think this is sort of maybe on the land, isn't it? Purchasing land and you can maybe subdivide, or you can just sort of like build a brand new property. I think we've sort of touched on that. earlier.
I mean, you could buy an existing property, knock it down, and develop. But I think we touched on this when we spoke about vacant land.
I think where people have made money is they buy that block, and again, it just depends on how far into the land release it is. Is like right at the start, like the block might have been only 200,000, but let's say a couple of years later might be 350, 400. So have you sort of missed the boat on that initial period? So if you sort of are contemplating it, what you would do is you look at how much is the block, how much would roughly the build cost be, what's it going to be worth, like what are recent sales at the moment, and what's sort of the price difference. I think that's a good way to work out if there's any money in the deal. And you want to add a big buffer in there too. You don't want to go in blindly.
So you can make some money, but it's probably something you shouldn't get into early. You should sink your teeth into simple buy and hold with residential.
Well, you can like tie your hands back. Like I said, you buy that block and you might have to wait 18 months to 24 months, but then interest rates might have skyrocketed, so your serviceability's been impacted.
Or good point.
Maybe like you have to think, well, do I want to buy my own owner-occupier home? So I'm not going to go buy a block of land if I want to buy my family home in the near future.
Yeah, when you decide to do a development, you're locking yourself into a certain period of time.
Yep, and it's just high upfront costs too. And then I think lending can be a challenge at times too. Student accommodation.
Yeah, so student accommodation, this is where you buy something probably close to a university. And the idea here is you rent out per room to a bunch of students. So you might have higher yields as a result because you're charging per room rather than the entire dwelling. But then you could have student accommodation that is just a studio apartment, and then you've got risks of lenders not finding it attractive. The only person you can sell it on to is probably another landlord, so that's another risk. There's some cash flow plays, but of course, whenever you get too focused on cash flow, you miss out on what's more important, which is the capital growth.
Yeah. I think I've again seen a lot of clients where they've bought like a little studio apartment or like student accommodation, and just the capital growth hasn't been there. They might have bought it for a certain amount, and the costs I think are quite substantial to maintain them. It might be like, let's say you've got like one of these studios in a complex of 300 to 400. Like, where's the capital growth in that?
Yeah. And you can have some lenders just boycotting those really tiny, specialised sort of properties.
Yeah.
So there's risk.
How about real estate crowdfunding?
So this was like I was speaking before about propertycrowd.com.au. I hope it's property crowd, not crowd property. That would be embarrassing.
Well, you could try it either way. It doesn't matter.
Yeah. So the idea is that you've with this crowdfunding is, in fact, I think maybe it's not crowdfunding. What I'm thinking is more like Domacom and BrickX, where you buy a small portion of a property as a crowd. So you put some money in, a bunch of other investors put some money in, and then the manager purchases a property, and everyone owns a portion of that property. So it's a great way to get into property investing without having enough to buy a property yourself. Like, you don't have enough for a deposit.
Yes.
Yeah. So there's pluses and minuses for that. The disadvantage, of course, is you don't have any control over it. It's the manager of that fund that looks after the property. And
you're not leveraging, are you? Or you are? Like, if you're putting money in there, or because...
Yeah, I think there are some cases where you can leverage, but with many of them, you don't get the benefit that you would if you were the single owner yourself.
Yeah.
Yeah.
Yeah. Okay. Also, like, I think a bit of a closing thoughts is, again, we sort of like keep it simple. Don't overcomplicate it.
Until you've got the experience, of course.
Yeah. Well, it just depends on how active that you want to be. I think, from my perspective anyway, buy, hold, forget about it.
Yeah.
In a good area.
Yeah. I mean, that is the easiest way, the most foolproof, easiest investment in real estate is you buy a house, not a unit, because houses have outperformed units. You buy established because new underperforms, and you buy in a built-up area where there isn't that vast tract of vacant land that can be oversupplied for decades into the future. And if you do that, it really makes property investing very simple. And you don't need any of our expertise for it. You don't need our data, that's for sure. And if you've got time on your side, that'll work for you.
I think, look at your goals, like your risk tolerance. And I think our three main things is look for capital growth, which is the main thing. But then we want the cash flow behind it too. We want both, really. Yeah. But that nice sort of sweet spot, and we want the least amount of risk.
Yeah.
Yes.
And that's simple residential investing. Yeah.
Okay, well, are there common mistakes that you see beginners do often with everything that we've discussed today? Or I can start with this one.
Yeah, go on.
I've seen people buy studios, high-rises.
Off the plans.
I've seen it.
There's been some shocking stories.
I've seen a lot of great stories, and a lot of them was just sort of like they just sort of purchased near where they lived, and they've done really well, but then I've seen them not do so well. But it's just time in the game, I think, is important. But if you can get in on that upswing in a market, that's ideal, because anyone can really buy anywhere and say, it's a great property. Well, you need time to do the talking.
Yeah, that's right. How do you know it's a great property? As soon as you've bought it, you don't know until you've owned it for at least a few years.
Yeah. Do you want to add anything on that? Like, what's some common mistakes that beginners make?
Well, I think that's the next episode.
No? The marketing? Be careful of marketers?
Yeah, but I reckon that's next episode.
Okay, we'll touch on that. Okay, no problems. All right, well, thanks for listening. To stay updated with our property insights and content, Jez, what should everyone do?
Click like and subscribe.
Click like, subscribe, like, share to the world. See you in our next episode.